Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we're back with our EIA show, and we want to go through what's been happening, what happened last week, what happened this week, and where are things going to continue to play out. And one of the things that we want to look at is, we've seen some decent builds on the crude side, but is that something that's going to continue? Where do we see some of this activity? And right now, when you look at products still remain in a fairly bullish backdrop. More specifically though, diesel and distillates continue to be in a very, very good spot on a pricing side, not so much in terms of availability, but in terms of pricing, while gasoline builds continue, not so much in the US, but we'll talk about that more in segment 2. But when we look at Europe, when we look at the Middle East and more specifically Asia as well. So we're definitely getting some of that shift. In general, the EIA report, there we go, was pretty much, I want to say it was bullish, but it was kind of neutral into the bullish side, just because products continue to be at such a good spot in terms of pricing and really incentivizing the refiners to run. The problem now is, can the refiners get the type of crude they need to increase the distillate cut? And so far the answer is no. And that's why we continue to see these issues, because a lot of these different crudes that are required, especially when you're looking at the US, is that heavier cut. When you're looking at Canadian crude, Venezuelan, Mayan, aka Mexico, when you start looking at Latin America, and we just don't have the right amount. And that, again, would be beautiful right now to have the Keystone Pipeline, but again, alas, here we are. So one of the things that we want to look at is look at Russia seaborne, because when you look at how Russia's trying to shift this, and the availability is important, because if you're not using Urals, you're using Iranian heavy, and we both know where those are in terms of availability, or at least purchasing, which is why the EU has struggled to really roll out any sort of ban. Before, it was Hungary that was pushing back, then it was Greece. So we're not seeing any real push in terms of trying to do it. The G7 is going to phase it out. Japan's going to do it over time. The EU is trying to push through and giving different countries adjusting, let's just say, timeframes on when they can come out, whether that's 2023, 2024, to try to get that pressure on Russia. But here you can see, just as of through May 6th, you can see where the exports are into the Arctic, into the Baltic, Black Sea, and the Pacific. The big shift is going to be trying to get as much crude into the Pacific as possible, but there's always going to be those limitations in terms of can they have the pipeline capacity? Is there the demand for it? India and China have been pushing back, more so India on pricing, just because when you look at where India is, you're either coming through the Malacca Strait if you're coming from the Pacific. If you're coming from the Black Sea, you're coming all the way around Africa, or you're trying to come through the Suez Canal, different types of ways. So India would buy pretty much whatever they can. It's just, it doesn't make sense. Can you get a ship? One. Can you get insurance? Two. And then what is the time frame? So these are different pieces, but Russia needs the volume to get off their coast, needs to get it through the system, because they don't want shut-ins, and they're willing to pay, or at least offer, whatever clearing price is available. Now, when we start looking at the global backdrop, total oil and product stocks, you can see the deficit narrowed from 116.6 to 106.2. So we're continuing to see that build up in terms of oil and products. But to be clear, it's more on the crude side. Products still continue to be in a bullish spot, especially on the diesel front. It's more being driven based on where crude is. So crude continues to see some of these builds both offshore and onshore. And a lot of this is mixed to just some of the timing. Things are finally moving through the system. And then you also do have that slowing demand, just because prices continue to rise. Within the US, we have gasoline and diesel both sitting at record pricing. So then when you factor in total crude stock loading and land and floating, you can see the deficit narrowed from 42.1 to 34.9. And that's going to continue based on the fact that the US had a build of 8.5 million. Europe had another build. You're continuing to see these builds on land, and then there's more and more crude getting pushed offshore. And we'll talk about that because crude on the water has increased to a record, obviously still below 2020. But if you take away that, crazy year that we had, you were still sitting at a record pace, and we'll show that in segment 3. Now, total oil product stockpiles, the deficit narrowed from 74.6 to 71.4. So it narrowed, but it's just more along the lines of flatlining. And I think it's important to appreciate on both of these charts. When you look at it, we normally build in crude this time of year. So it's really what is the rate of change in terms of the build? And it's slightly faster than normal, where when you look at total oil products, you're starting to see that pivot right when it's supposed to. So the question is going to be, how fast is that rate of change? And based on the diesel market right now, it won't be all that fast. Now, the struggle that the refiners are going to have is when you make diesel, you inherently make gasoline. So how much diesel can really be created? Now, one of the things that we have coming into the Americas, bookings for May loading shipments of clean fuels from Asia to the Americas continue to rise. We're now up to 270,000 tons compared to 200,000 tons a week 2 weeks ago. So again, you're starting to see that acceleration. China's net fuel exports rose to 2.34 million tons in April, the highest since June. As again, they're trying to manage some of those different pieces, with consumption of gasoline, diesel, jet down about 20% in April and continuing to have those headwinds through May. So as they try to manage that storage, we're going to see more of that being pushed into the market. And based on our situation, especially in Pad 5 or the West Coast, we're going to be pulling down as much product as possible. So then when you look at land storage, you can see that the deficit narrowed from 91.2 to 88.9. So again, this is because the more of this is being driven by the offshore storage side. It's just going to remain just how quickly can we pull it off? How quickly can it be moved through the system, which continues to be some of those backdrops. The west of Suez, the deficit narrowed from 75.6 to 71.4. That's going to continue to narrow just because the U.S. again had a big build. Europe had a build, so that's going to be one of those that's going to come back. Where east of Suez, the deficit slightly widened from 20.6 to 23.8, and we expect that to hold pretty close to last year's level of 2021. So then when we start looking at floating storage, here you can see that the surplus narrowed from 31.3 to 30.9. That's something that we do see expanding, just given, again, that timing of when is it in floating storage, when is it in transit, and we do have an accelerated amount in transit that just recently got converted into floating storage, which will show up in next week's report. West of Suez, the flipped to deficit. It went from 0.9 to negative 4.9, and that's something where west of when you look at West Africa, we actually had a fairly sizable drop, and it's because they were cutting prices. They were trying to get as much crude into the market prior to the July loading schedule, because the July loading schedule should be this week and or next week. So you want to clear as much of May as possible, get as much of June as you can, and try to clear some of that floating storage to ensure that you have that capacity in the water, which again push that through. East of Suez, the surplus widened from 30 to 32.3. That's something that again that we think is going to remain elevated and just trending a bit higher. Now, when you look at U.S. weekly shifts, European gasoline plunged to the lowest since early 2020. U.S. weekly imports of European gasoline fell. That's something that we do think starts to adjust, just given where we are in Pad 1. Like Pad 1, for an example, on the gasoline side, we had a drop of 530,000 barrels. That's 14.2 million below the 5-year average. So we have more than enough space to bring this capacity into the U.S., and we're going to need it because holistically within the U.S., gasoline is about 14.1 million below the 5-year average, but a huge part of that is driven, and really 90% of it is driven based on the shortages in Pad 1. So then when we look at crude stock, here you can see that we had a build of 8.49 million. You can see that the build was across the board. We're still 87.8 million below the 5-year average, but it's a pretty steady flow in terms of where some of this is coming, and this is actually happening when imports were down. So we do expect to see imports remaining a bit elevated in terms of where they should be, but they're still going to be well off of normal, especially when we compare it to Pad 3. So here you had the build in pad 1. Pad 2 had a build of 1.37 million, but that's still 35.6 million below the 5-year. And then Cushing, as we were saying, was going to continue to fill, but it wasn't going to be a straight line, and we had a small draw of 590,000 barrels, still 24 million below the 5-year average. But again, the rate of change is still taking us higher, with pad 3 having an increase of over 2 million, but that's still 22.1 million below the 5-year average. And in order to see a big increase or big pivot in that refining capacity, we're going to have to see imports really start to accelerate. And then pad 5 had a pretty sizable increase in imports. Remember the lumpiness that we've been talking about. So we do expect to see some of that. Now on the SPR, we actually had it going a different way this time. We had an increase of 1.5 million. And remember, there was some earlier sales that were not so much outright sales, but had to be replaced with crude. Then we have Biden that is talking about purchasing oil for the SPR. And again, just trying to manage where some of this is. There was a small drop in crude production of 100,000 barrels. That's something that we do expect to reverse over the next few weeks, just because. But remember, we never really were at that 11.9. We thought we were at about 11.87. And then when you look at some of the shifts that normally happen, especially during April, when you're considering Easter, spring break, a lot of these different holidays, we typically get a little bit of a dip, and then we have that run that continues through pretty much the summer months. And here's just an example. When you look at 2019, you can see here we had that little bit of a dip. When you look at 2021, same kind of gyrations that we typically have. So it's not too crazy to see this, especially this time of year. And then we have a bit of that run as we go through, and those completions accelerate into the summer months. Now, when you look at runs had an increase of 1.6%. That's 230,000 additional barrels coming a day coming through the system. The drop was a bit more last week than we were expecting to that 88.4. We didn't think it was going to go back below 90, so now here we are above right at 90%, and we do expect to see that trend continuing with utilization rates now taking a steady rate of change back to about 94% utilization rate. You can see that it was driven by pad 5, with most of the pads seeing some sort of increase except for pad 4. And we do expect to see pad 5 and pad 3 continuing to add some of that additional capacity. We're right at the 29-year average, just based on, as we were saying, that trend towards 94% utilization rate. When you look at that dotted line, that 29% average, you can see that we gradually get to those levels and continue to see some of those increases over that period. Imports had a drop of 64,000 barrels a day. That's 292,000 below the 5-year average. But I think it's important when you look at this is that pad 3 continues to be well below normal, 409,000 barrels a day below what the 5-year average is. And that's something where there's timing in that. There's a lot of pieces to that. But in order to see a big step up increase in refining utilization rate, especially because a large part of our refining is on the Gulf of Mexico, we're going to need to see that change because we just don't have the right mix of crude to see that acceleration, which is why we're going to have to see imports increase. And if we don't, we're going to continue to see a fairly lackluster refinery utilization rate. Pad 5, again, we've said it, lumpiness. That's something where we do see that shifting down a bit. Still, based on what we're seeing on the boat side, it's still going to be above the 5-year average, but just a bit below where we are today. Now, when we look at just the general imports, one of the things that we've been saying is that trend towards the 5-year average, but not quite to it, just between kind of where that low end of the cloud and then that middle of the range. So we do expect that to continue to move up and set, let's just say the highs for 2022 on imports into pad 3. So then when we look at imports into pad 2, as we were saying, we expect to be either right at the 5-year average or, at the top end of that cloud. That's something that we do believe is going to continue, especially because of the importance of getting some of that Canadian crude down into the U.S. because of its current quality and heaviness. Implied demand continues to be a bit soft. You can see gasoline had a drop of 154,000 barrels a day. We did get that increase that we were talking about when we filmed 2 weeks ago, that we were going to get to about 8.9 million barrels a day of demand. We got to 8.856, and then we expected to see that spike and then fade. And here's that fade, and now we should just be essentially flat at about 8.7, just given where we are. We're pretty much at a point where we're not going to degrade much further, even if prices go up. Like as we talked about, gasoline prices have gone higher. That's not going to really change too much. We've kind of found that flattening. The question is, how much is price going to limit our bump? That summer surge, and that's where we see those pressure points. Distillate continued to find some problems. We did talk about that increase. We got it. Then we have the fade. And that's just because there is the cost of diesel, the availability of diesel. You're seeing that pressure, especially in the trucking market. Jet fuel, as we've been saying, 1.45, 1.55. We're right at that level. We just see it staying here. And then propane had a drop of 204,000 barrels a day. That's just because of a lot of that is due to weather. We didn't need any heating. We didn't need any real adjustment. So when you look at the weather side, that is now gone. But we do see that propane remaining above that 5-year average. Now, when we look at going into the U.S. gasoline demand, here's where we kind of are finding that flat ground. We're below where we were in 2021. We actually don't really see us closing that gap at this point. And a lot of that is just driven based on price. When you look at where prices are versus last year, there's a lot of headwinds, and you're seeing people really adjust kind of how are they driving, how much are they driving, but you still have to drive. It's not like you can stop driving. You can just try to plan so you drive less. And that's where we're seeing where we're not going to get that huge drop off we had in 2020, but it's just you're going to kind of bump along the bottom, because this is where I think that the flattening and if it's something where even if gasoline went to $5, I don't really think you'd get that huge drop. We're kind of at that flattening point just based on shifts, and we'll have another chart in segment 2 discussing that a bit further. Now, when we look at U.S. crude oil inventories, excluding SPR, you can see that we're just curling back up towards the 2018 level. We expect this to just, again, bump sideways, just that chevron pattern. In terms of draws, especially when you look at gasoline and distillate storage, we should see refiners picking back up and pulling down some of that additional crude, and again turning that into product. Days of supply is going to continue to go up, especially because of where we sit on the big build. This is about a week lag, so again, just pretty stable at this point in time. Now, when you look at total U.S. commercial oil storage and products, we continue to trend down. It's something where I think we just really kind of hold this spot, and it's just going to be crude getting converted into product. So you'll get a more bullish crude number in terms of draws, and we should see some of that getting moved into the gasoline distillate storage side. But again, exports continue to be strong, so that is also acting as a drain, pulling some of that and sending it into the international market. That has kept us at a fairly steady down move, even when you factor in some of these ebbs and flows. I just think that when you look at the numbers, this is where you typically kind of get this flattening and a little bit of a pivot higher, and that's something that I think is likely in the near term. Now, when you look at gasoline storage, you can see that we've had a fairly sizable drop, and we're actually following 2019 almost perfectly. And I have a chart for that in segment 2 just to clean this up a bit, and you can see that right now we're just following 2019. Now, the question is going to be, when does that flat line, when does that shift? And when you look at 2019, this is typically when you get these big drops and then you flatline and then start to see some of these builds into the beginning of June, and then you have some of that drawdown that really picks up in July, which July and August being kind of the peak months in terms of movements. That is something to watch as we head into June. Distillate, no matter how you look, we should have already flatlined and started to see a rate of change higher, and the draws keep coming. So again, distillate in general just continues to be in a very bullish backdrop, which is obviously being reflected in the crack at this point. Jet, a little bit of an increase. When you look at what's being prepared for, again, we typically get an increase in flying. We'll show this in the TSA data. So far, we haven't seen the normal seasonal pivot. It could be another week or two before we see it. But again, when we'll show this, there's typically that pivot higher, which we saw in 2019 and obviously in 2021, just at different starting points. When you look at the curve, a 65 continues to kind of be that base for projects when you look at where that shift is. And as we said 2 weeks ago, I didn't quite understand that big drop in the later months, but you can see that has been bought back up. You've seen the curve shift over, but a bigger shift at the later months, which I think makes a bit more sense. We're still above 85 well into 2023. So again, you still have a lot of reasons to see activity remain robust, especially if you're looking to layer on some hedges, here we are. So then when you look at COVID, COVID continues to kind of be a non-event. We're seeing a little bit of an increase in the US, but nothing I think that is concerning in general. Then you look at Asia Pacific, small increases, Japan. China continues to be trying to their zero COVID policy, which even though when the actual cases have dropped according to their numbers, they're still concerned about spread. They're still getting domestic spread. And that's, as you remember, they have that zero COVID policy, which is obviously creating some of these issues. When you look at pad 3 is below 2019, but you can see it's trending towards that level. And I think when you look at the distillate side, you look at the product side, there's now in the available gasoline storage, and I think you're going to start to see them pick up their activity. But they need the crude to do it, and then they do have the capacity to store it at this point in time. So then when you look at Cushing, again, just kind of trending up, we're moving back in the right direction. I just think that we're going to continue to see that upward momentum, but it's not going to be in a straight line. And we're going to continue to see that move higher. Floating storage still low. It's just a matter of how much of it can be imported, how much of it gets stuck in storage. And again, as we talked about, the waterways are a bit narrow. If you're exporting, you have to wait for the export boats to clear so you can bring in the other boats. And these are some of the different shifts that we're continuing to see over that time period. So that's what we have for you right now on segment 1. In segment 2, we're going to go deeper into the U.S. We're going to look at, where are we on demand, and do we have more tailwinds or headwinds at this point? And we're seeing a bit more headwinds, especially when you start looking at pricing and that demand profile.